So right at the outset, I'd like to emphasize that safe production continues to underpin the way in which we do business. I'm pleased to say that we've had no fatalities at our managed operations in the first half, and we continue to see improvements in all key safety performance metrics. Highlighting the half's key achievements, it's clear that our value proposition is delivering value. Aside from the strong safety performance, we've had recognition of our leading ESG performance, with the first place ranking by Sustainalytics out of 55 peers in the precious metal sector globally. We've had robust PGM fundamentals, leading to a 33% improvement in rand basket prices, particularly helped by palladium and rhodium and a weaker rand. Our return on capital employed increased to 45%. We've got a strong balance sheet, increasing our net cash position to 6 billion rand. And finally, the board, thanks Norman, has approved a dividend based on the payout ratio of 40% of headline earnings, leading to a cash dividend of 3 billion rand or 11 rand a share. We continue to ensure that the manner in which we conduct business minimizes harm to the environment and supports surrounding communities, mining responsibly and sustainably. We have clear carbon and emission reductions pathway, and you can see from that top box, we continue to reduce emissions and energy intensity. We're assessing the potential to use renewable technologies within our portfolio, and they include the launching of now a tender process for our 75 megawatt photovoltaic plant at Mogalakwena. We're also assessing further potential solar farms at Unki and at our processing operations. We're screening the opportunities to use fuel cell trucks in our fleet, and we think by this time next year, we'll have the largest fuel cell truck operating anywhere in the world. We also continue to invest in our smelters to reduce sulfur dioxide emissions with a capital investment program of 2.5 billion rand over the next 5 years. We actively invest in creating value for the host communities and to make a positive impact on society. You'll remember that we increased the donation of land with a further 270 hectares of land donated to the Rustenburg community in March of this year, supported by the national government. On the right-hand side of this slide, you can see that we continue to receive global recognition by respected institutions for our ESG performance, including being awarded, as I said earlier, a first place ranking by Sustainalytics out of 55 precious metal peers in the global mining industry. Mogalakwena continues to deliver and had another strong performance, producing 610,000 PGM ounces. This was a 5% decline off the very strong performance that we had in the first half of last year. Eskom power outages impacted our production by about 12,000 PGM ounces. There was a decrease in the concentrator throughput and recoveries due to a shutdown that we had for maintenance on the secondary mill at the North Concentrator. We had scheduled in the first half of this year an increase in waste tons mined from a new mining cut at Mogalakwena. We also had some lower equipment availability, and the combination resulted in a decrease in the ore mined portion of the pit over that period. That has been partially offset by a drawdown in ore stockpiles. In the second half of this year, we expect a greater mining equipment availability. We had a purchase of an additional 2 trucks, and as well as mining the ore that we've now exposed will result in greater mined production in the second half. Despite these headwinds, Mogalakwena had the best EBITDA margin in the portfolio of 57% and a return on capital employed of 47%. The mine generated 3.8 billion rand of economic free cash flow at a negative all-in sustaining cost of $292 per ounce. And that highlights the benefit of the basket of metals that we produce at Mogalakwena. So taking a moment to reflect on our value proposition, which is based around three key pillars. Firstly is the quality of our assets and operational excellence. Secondly, around capital discipline and shareholder returns. And thirdly, around the long-term sustainability of our business. We are underway with a revised strategy from what we previously internally described as a burning platform to what we're now describing as the burning ambition to further leverage our differentiated value proposition. So the next phase of value can best be described on where we're focusing to see that value from in these four blocks. On the top left-hand side, you can see the block that we're calling P101 and Future Smart. That focuses on our assets, on the optimization of our assets by achieving and beating global benchmark, and we call that internally P101, as well as modernizing our assets and the use of future smart technology, which we'll go into a bit more detail later. On the top right-hand side, we still remain committed to low capex, fast payback projects. You can see the list of projects there. We still believe that significant value can be generated through the investment in chrome at Amandelbult and Madikwa, modernization of the 15 East trackless section at Amandelbult, concentrated debottlenecking at all of our operations, and the base metal refinery, a copper leach circuit improvement. On the bottom left-hand side, we continue the studies at both Mogalakwena and Mototolo Der Brochen to find the best value options available to this company. As the studies are progressing, we're seeing further optionality in the high-quality assets that we own. But we do need to conclude these studies to see where the next best value is for the company. Both Mogalakwena and Der Brochen have moved to the next phases of study in this first 6 months. On the right-hand side, the market development continues to be a key strategic investment. We continue to think about this as an investment, not a cost. We've made further substantial progress in the first 6 months, including with the introduction of a new partner into the AP Venture Fund. Now we have 4 partners, 2 additional to ourselves in the PIC. This latest partner is Toyota's Mirai Creation Fund. We've also launched very recently the Lion Battery Technologies with PTM to accelerate the development of PGM-containing battery technology. We've also launched new products in both the jewelry through the PGI and new strategic partnerships through the World Platinum Investment Council. This slide highlights some of the work that we've been progressing on P101 and utilizing future smart technology to ensure that we achieve and beat world best practice across our operations. You'll recall in February this year at our annual results presentation, we started sharing some of the thinking about where we saw potential. Now we're highlighting how some of these technologies could potentially benefit our organization. You can see that a considerable amount of work has taken place on the development of these new technologies, and you can see across both mining and processing some of the progress that's been made in the last 6 months. We are maintaining all the guidance that we gave to you in the beginning of the year. Firstly, for produced, refined, and sales volumes, all of which, as you recall, exclude the toll refining of 4E ounces for Sibanye. Firstly, PGM production that remains between 4.2 to 4.5 million ounces. Refined PGM ounces, you'll see, remains above what we produce for this year only, as we have some of the benefit from 2018 material flowing over, and therefore are expected to refine 4.6 to 4.9 million ounces, and likewise we'll be selling between 4.6 and 4.9 million ounces. As Craig mentioned, as we previously guided, our capital expenditure will remain between 5.7 to 6.3 billion rand. And also, as Craig promised, our cost performance, which has been higher so far this year than input cost inflation of 7.5%, we believe that we can limit the unit cost increases to between, probably at the upper end of the range of between 21,000 to 22,000 Rand per platinum ounce. I think it is important just to caution, though, that there are potential headwinds in the second half of the year with wage negotiations and, as we come through the winter period, potential disruptions at Eskom.